Kevin, obviously we've gotten a firmer start to this year in the broad markets. I know you're a value guy. You're looking for stock by stock. It feels like it's been relatively easy to identify value, less easy to get paid for it.
Yeah, I mean, that's why one of the things we do with our methodology, which we call private market value with a catalyst, we're looking for catalysts or events that can surface value in a stock. Big one for us tends to be M&A, takeovers. And that's one thing with the new administration. We think certainly they'll have a lot of pro-growth economic policies that are good for everybody. But specifically on takeovers, we think they're going to be a lot friendlier. Last year, takeovers were up about 10%, 3.2 trillion globally, but still well off the peak. We think that's going to accelerate into this year, and we think that we're going to identify a lot of targets.
Yeah, I mean, M&A volumes as a percentage of GDP, as a percentage of stock market value, really pretty low versus history, right? So what pockets of the market or what individual names do you actually feel like are pretty ripe in this scenario?
So we're looking across the board. We do see some areas that are particularly ripe for consolidation. One I'd say is the food industry. They've struggled of late. There are some headwinds, inflation, just a tighter consumer. The threat of GLP-1s coming in. We did have the Kellanova deal announced last year by Mars, but I think a lot of the bigger food and beverage companies, they need growth. So when they're going to buy that, they're going to look for these companies like, say, a Bellring Brands or a Simply Good Foods that have healthier snacking, shakes in growing areas of the food market. Those would be particularly ripe for consolidation. Others in the industrial area we think are pretty teed up as well.